It is imperative that there is a strong focus on the process of long-term decision-making in order for a business to optimize its probability of success. Within long-term decision-making, a business must comprehend the operational, tactical, and strategic decisions. Effective decision-making will allow for the business to successfully achieve their business objectives. For every business, objectives vary, which ultimately impacts and catalyzes management's long-term decision-making. Some generic business objectives are profitability, liquidity, efficiency, growth, and solvency. I'll now analyze and shine light on long-term decision making in regard to the different financial statements. A balance sheet is a condensed statement that shows the financial position of an entity on a specified date. Among other items of information, a balance sheet states what assets the entity owns, the liabilities they have incurred, and the extent of equity. A strong proportion of decisions in the long term will require knowledge from their assets compared to the liabilities and equity, specifically through gearing and solvency ratios, thus making the balance sheet a critical instrument for financial decisions. Comparatively, the statement of financial performance demonstrates a business's profit or loss at the end of any given financial year. Specifically, it is essential that managers and the business understand this statement as they can interpret their operational success or failure and therefore make adaptations for the long term. In order for a business to establish long-term objectives, they must comprehend their current financial performance and recognize innovative strategies to boost their performance. The cash flow statement is a summary of the inflows and outflows of cash in a firm over an accounting period. This statement is categorized by a business's operating, investing, and financing activities. The most common example of operating activities are sales or cost of goods sold, whereas investing activities refers to the sale or purchase of a non-current asset. Financing activities are demonstrated through the debt borrowing or the issue of common stock. Together, this framework elucidates the overall net change in the firm's cash flow for the period, ensuring management utilizes the information to make strategic alterations. Finally, the statement of changes in equity is comprised of the opening balance of equity, the relevant movement in profit or loss, adjustments in share capital, potential dividend payments, and subsequent increases or decreases in reserves. As a result, shareholders and management are concerned with their stake in capital gains in the business, which is ultimately reflected in this statement. Overall, decisions in the long term are orientated around what reserves will be utilized for, if a dividend will be paid, and the decision to alter the share capital. Ultimately, these decisions, combined with stakeholder interest and macroeconomic conditions, form the basis of what influences long-term decision making.